Good evening, everyone, and welcome to the second of three Farmers Weekly webinars on tax in partnership with accountancy firm Baldwinds. I'm Andrew Meredith, Deputy Business Editor at Farmers Weekly, and I'll be doing the housekeeping tonight. After studying succession in our first session last month, tonight we'll be taking a close look at best practice when securing access to finance. I'm delighted to be joined on the line by three highly qualified speakers who will be more than able to guide us through the latest advice on this. First up will be agribusiness consultant Rob Hughes, who is a partner with Brown & Co., a firm of chartered surveyors and business consultants across East Anglia, the Midlands and the Yorkshire and Humber region. We will then hear from another Rob Buse, who is Director of Banking and Finance in the Agricultural Department of Baldwins and is based in the West Country. Our final presentation will mercifully be from an Andy Dodd, who is now a dairy business consultant with the Farm Consultancy Group after working both on farm and for the AHDB in dairy roles. After all of the speakers have finished their presentations, there will be time for a question and answer session. Please submit questions for our speakers at any time by typing in your query in the auditorium box that you will find on your screen, and then I will be able to direct them to our speakers. The whole webinar is expected to last for 1 hour, and afterwards we will email you copies of the slides and answers to any questions that there was no time to address. So without further ado, I'll hand over to Rob Hughes for the first presentation. Thank you, Rob.
Thanks, Andrew, and good evening, everybody. The title of this webinar is pretty apposite in terms of the uncertain times, as uncertain times, of course, they most certainly are. It feels like we're in the midst of an unprecedented period of political uncertainty that could lead to enormous economic strain on our farming businesses. So now, perhaps more so than ever, we need tight control on our businesses and a complete understanding of what drives its performance, so that those who provide our vital funding streams can continue to do so with confidence and certainty. Over the past 10 years or so, in my experience, banking has changed quite markedly in the way that it approaches its relationship with you, the farming customer. Personnel are ever changing, and the requirements of the relationship manager, as they're now widely referred to, are exacted by his or her credit department and their need to know their client. Decisions are frequently made now by a credit team who will probably have some knowledge of agriculture, but be prepared for it to be limited. They will almost certainly never have been on your farm or ever will. So when applying for funding, you need to paint a very clear picture to your relationship manager about who you are, what you do, why you do it, why you need funding, what for, how much and when, and vitally, when and how you're going to pay the money back. So what are the bankers looking for? Well, the first thing to do is ask them. Ask them what they need. What do they want for you to help them to report upon? What are their needs in order to be able to take your proposition forward? Gone are the days of purely offering more security to gain additional funding. They need much more information from you than that. Our experience recently is that they're looking very hard at historic business performance. They want to examine your P&L account, your balance sheet trends, and where your cash has been going over recent years. They want to establish what your previous practice has been and what your future performance is likely to be. So in doing so, we would produce a table that might look a little like the one on the slide on your screen now. It's a very simple table of profit and loss account analysis that you might be able to adopt. You need to be able to explain clearly what's been going on in your business. Why have there been some quite significant variances in performance? It may be down to weather, it may be down to management change, it may be down to personnel change, expansion or contraction of your business. Be prepared to verbalise very clearly why those variations from year to year have taken place. Then what are you doing to manage the risk? What are you doing about sales decisions, purchasing decisions? They all need explanation. Added to that table in front of you, if this was a specialist farm, a dairy for instance, we would add a column there for revenue and cost on a pence per litre basis. For example, if it was a pig farm, pence per kilo of pig meat sold, and so on and so forth, so that we can very clearly get to a position that recognises unit cost of production and helps our relationship manager and thus his credit team to begin to understand in some thorough detail what's going on. Here is an extension of the previous slide in terms of the cost structure and the need here to provide a strong commentary as to why your costs are varying, either up or down, so that people who have never set foot on your farm, and who probably never will, have gained some strong understanding of you and what your business is up to. So don't be frightened of this data, even if the numbers aren't very good. If you've had a poor trading period, be upfront and honest with where the numbers are and where they're going, so that that everybody involved gets a thorough understanding and a commitment from you that you understand your numbers in turn. We would always develop these numbers through the balance sheet to a source and application of funds. So we take the P&L and the balance sheet and see what's happening to the true cash position in the business, so that everybody can clearly see how cash movements can be described from year to year. So in this example, down the left-hand side of columns, you see the source of funds, the source of cash that's being generated within the business, and on the right-hand side, you see how that cash is being spent below the line, as it were. So notionally, were this business just to have produced a cash flow, in the bottom right-hand corner there, you see a position of cash at the bank increase, a cash surplus of 100,000 quid, and that would indicate very superficially a strong trading position and a healthy cash retention. But once we get into the source and application, we can see down the left-hand column that there was £33,000 worth of loans introduced, capital reintroduced from the family of 34,000, and a tax refund of 50,000. You might question in your processes then the repeatability of that level of cash performance, and that only comes out really when we start to examine in detail the source and application of funds. So again, don't be frightened of the numbers, produce them and be honest about them, and help to paint that very careful picture of what your business is really doing. There's a balance sheet, and again, we're looking at trends here. We all know that valuations in balance sheet are never up to date, particularly apropos fixed assets and frequently machinery in terms of where they've been written down to. But it's the trends we're looking at, and we want to see that the business is generally progressing in a healthy manner, and if it isn't, maybe creditors have increased dramatically, or the debtors perhaps, why it's happening, and what's consequently happening to the overall wealth of the business at any given moment in time. And then we budget, and the budget is core to indicating what your future business performance is likely to be under a given defined set of parameters and circumstances. So the key to budgeting is to do it reliably from core-based data. Explain and detail your assumptions, and in our opinion, start from a budgeted P&L or net farm income position and let that drive cash as opposed to just producing a cash flow, valuable in itself, but incomplete in its nature. So the key to reliable budgeting and to you gaining your appropriate desired level of finance is accuracy, honesty and reliability in the numbers. They all come out in the wash, don't they? 3 months down the track, if you said you're going to receive £100,000 in wheat sales and only 50,000 turns up because you've put £250 a tonne in for your wheat price, it all comes home to roost. So let's be accurate and honest and reliable, and let's show in very clear terms how cash is going to be generated and retained. And write it in a form, as best you can, that provides clarity to a non-expert reader. So these guys who might be sanctioning whatever level of finance you require may well not understand the intricacies of your enterprises and certainly your business in absolute detail. So assume nothing and clarify everything. So how do we present those budgets? We would always start from detailed gross margins. Here's a net farm income projection, which summarizes gross areas, gross margin per unit area, and total gross margin generated at the top of the page. It works down through other income generated in that farming business to give us a total farm gross margin. We then lop off our fixed costs, our rent and finance charges, and that leaves us with a total net farm income. That budget is driven very clearly from clear and detailed, documented assumptions on gross margin. And that enables you to put all the checks and balances into your budget that you need to do to ensure that your thought processes and assumptions are accurate and reliable. Then let that drive cash. So that then comes through to a P&L account. So here's a profit and loss account, exactly the same data but shown in a different manner, much to the way that you would expect to see it in your annual P&L accounts as produced by your accountant post the year end, but it's the same data. We might be very strongly inclined to insert that data in a fourth column, as it were, against the previous year's analysis, so that there's a very clear correlation between historic performance and future budgeted performance, and that highlights where the variances are going to be, where the marginal cost revenue implication of your diversification project or whatever it is that you're applying for funding is going to result in. So that we get more clarity and we get more obvious points of question and answer. And again, we'd run that through to source and application of funds, much in the same way as we showed just a moment ago. And then, of course, vitally, cash flow, summarizing all the key events that are going to generate or consume cash during the course of the year and scheduling it over a 12-month period. We might flip that forward into a 24-month projection for the whole business if that was required by your lender. But again, we come back to meeting their demands as a key partner in your business proposition. So that's a real sort of whistle-stop tour to the approach. The key issues here, I think, are that the relationship manager, bank manager, call him or her what you wish, but they're absolutely vital to your business, and so include them in the process. Don't just present them with simple data that's incomplete because they won't be able to answer your questions in a way that you want them answering if we don't provide them with the data that they need. So be realistic in your projections and detail and explore the key sensitivities. What might happen if the milk price goes up or the milk price goes down, if the fertilizer price goes up, or if you have to purchase that tractor that you hadn't anticipated buying. Explain in detail why your business performance is changing. If you've been in a loss-making cycle, what are you doing different to break that cycle and put you into a profitable environment? If debt has been mounting for whatever reason, know why. Is it because of capital expenditure? Is it because of private drawings? Is it because of poor technical performance? But if you're honest about the way you present your data, it'll become very apparent very quickly. And be able to very clearly demonstrate that you can afford your debt structure. So don't be frightened of saying that we've got issues here in terms of our debt structure and we need to look at the whole in the round. And this is what we're doing to review our position. And these are the changes we're prepared to make and the implications of making those changes. And also be sort of conscious of the fact that leopards often don't change their spots, you know. So if you've come out with a track record of needing extra money because of P&L deficit, you're going to have to work blooming hard to correct that mind's eye view that your relationship manager and or his credit team might have of you. So you know, put that work in. Understand your numbers and buy into those numbers and take ownership of them, and be highly professional in your approach to their presentation. If the bank manager says no, and they do, don't they, sometimes, think hard about why they're saying no. Maybe they've got a point. Maybe they haven't. Maybe they've misunderstood. Maybe you've just got to go back and work harder, address the issues that they raise, and effect the change. So broadly, Andrew, that sums up my presentation in terms of what I wanted to cover with you this evening. The main gist of it is to know your business and grip your business, and then tell the right story to the people who need to hear it. And that's really the message I'd like to get over this evening. Thank you very much.
Hello.
Hello?
It's all gone quiet.
Yeah, who's that there?
It's Rob Hughes.
Hi, Rob. Rob Hughes still here.
I heard you also. I'm hoping other people did.
I've been running on.
I thought it was quite interesting.
Hi, thank you so much, everyone who's still listening. Unfortunately, I think we've had a bit of a cut from our host there, but I would like to bring us on to Rob Hughes, who will be leading the next part of the presentation. So over to you, Rob. Thank you.
Hello, good evening. Thank you, Ruth. Not quite sure what's going on there, but I hope everybody can hear me. So I'm Rob Hughes, Director of Banking and Finance in the Baldwinds Banking and Finance Department. Firstly, I want to apologise if I repeat or even possibly contradict various things that Rob Hughes has said. That's probably the nature of the business, and as much as every situation is bespoke. Just trying to do two things at once and moving a slide forward. Financing during uncertain times. Uncertain times seem to be quite frequent within the farming and rural sector, be it BSE, foot and mouth, or even, if I dare say, that Brexit word, which has already been tentatively touched upon. But that said, the farming and rural fraternity are also generically a pretty resilient bunch and seem to keep going forwards. Linking in with the other speakers, good accountancy, consultancy and projections, as well as being tax efficient whenever possible, is obviously paramount to you and your business now and going forwards. You might have a good idea, but after you've involved the various professionals, then decide that it isn't right for you, your family or your business, farm, or it just simply doesn't stack up and isn't viable. It's better to find this out now than it is before you've borrowed the money and are heavily in debt and then starting to worry about it. The last one on there is managing debt. Obviously, that's the biggest one I'm going to concentrate on. It's not so much the managing debt, it's where you can find it nowadays. This is a massively changing sector. So, again, I'm going to repeat the financing in uncertain times. Who is it that has the uncertain times? The borrower or the provider? Following the financial crisis of 07-08, the financial world has changed pretty rapidly, which has a massive knock-on effect towards the appetite of the providers as much, if not more, than the actual borrower. What had been accepted as the norm can be anything but that nowadays. What was verbally agreed 2 weeks, 2 months, or even 2 years ago might not be the same when you actually go and ask for the finance nowadays from the providers. Since 07-08, there has been a host of seemingly new finance providers mushroomed up to fill the void that this has left, where the traditional providers deem the risk to be too high or simply don't have an appetite within a certain sector nowadays. So as I see it, you now have 3 silos of money available to you. And Rob very much mentioned that the existing relationship manager, I'm just going away from the fact that, there are other providers nowadays. Silo 1, as you can see, is the traditional high street lenders that you mentioned. You've got the Barclays, HSBC, Lloyds, and NatWest, etc., as well as the AMC, who have been traditional providers within this marketplace. They're normally still the best to stick with for rates and fees, although they aren't always the easiest to deal with nowadays. And the overall appetite has changed significantly. They are much more concerned about the serviceability and affordability, as already mentioned, rather than just lending against asset base. You could have a multi-million pound asset base, but if your figures don't add up, it's just not going to happen. It's not always due to poor performance in business, due to poor performing businesses. It might be that the lender's appetite within a certain sector has simply changed. They might have moved the goalpost, not you. I have dealt with an average performing business this year, large asset base, where they have been borrowing and servicing interest only. The provider now wants capital and interest repayments, so we have had to move them, and the client hasn't had anything different effectively. They've just carried on as normal. That said, in the bank's defence, and having come from the bank, I do feel it is correct that they are reviewing their own business. The main issue that I still see from the 07-08 financial crisis is that they actually stopped looking at their own business, and so their appetite within certain sectors had to change. The biggest one was being that within the property market, as soon as that got a cold, they got flu, and that primarily was the major stumbling block of the whole 07-08 crisis. So the very fact is they're suddenly turning around internally and saying, do you know what, we're overly exposed within the dairy sector, within the farming community. I do feel that's them looking at their business, not saying that you've got a poor business. Although that can come across as being personally against you, the farmer, and finances are always personal, sometimes it's not, and you've just got to take that on the chin and move on. There are other providers out there. Moving on to Silo 2, mid-tier lenders. This inevitably comes with mid-tier rates and fees, etc. This type of funder has effectively become a lot more prominent since the 07-08. they've taken up the slack that the high street bankers are basically not lending against at the moment. You will normally pay higher rates and fees to cover a higher risk accordingly. This isn't normally a long-term option with normally a 3 to 5 year term, and then you're looking to hopefully go back into the high street lenders again when you've either proved that your projections are correct and that your business was correct, whereas they just simply weren't prepared to take that risk at the first scenario. Another case that I've been dealing on with this year ties in with the last couple of sentences, really, in as much as an existing small dairy farm looking at doing a large expansion of about £2 million worth. The existing banks kept saying yes, and then when it came to it, they declined to lend. But it obviously wasn't a poor situation because two other high street banks were desperately falling over themselves to lend that money to them, to which one was successful and is halfway through building a nice new parlour and shed, etc. Moving on to the high-risk silo-free, as short as possible, because the high risk and the high rates and the fees. There is a purpose and a place for this type of lending, but you have to have an exit strategy. There's no good going into this one and not quite knowing what you're doing. It can buy you time at best. It can either, like I said, buy you time for various exit strategies. That's what this one will mainly provide. There is a high percentage of property developers that use this, and it covers what used to be a swear word in my banking days was bridging loans. This is a very good place to go and find bridging loan money at the moment. I think I've basically gone through what I'm doing. It says, funding in uncertain times. Yes, it is uncertain times. The banks are changing rapidly. They're changing seemingly week on week, but there are also a variety of lenders and providers out there now. So you just don't take no as the first answer. I believe Rob Hughes mentioned that, that they do say no, and they say no more increasingly, but that doesn't mean no forever, and it doesn't mean that somebody else won't be prepared to take that risk on, although you might have to pay a higher rate for it. I seem to have gone through that very quickly. I'm not going to go into cases because every individual case is exactly that. I'm simply now going to thank you for your time and pass you back to Ruth or Andrew.
Thank you very much, Rob. Hopefully I'm coming through louder and clearer now than I was before. Apologies for the audio at the end of the first presentation. Without further ado, we'll roll on to Andy, a business consultant with the Farm Consultancy Group. Take it away, Andy.
Thank you very much. Good evening, everybody. I'm going to come at this from a slightly different angle and look at it from an on-farm situation. Agreeing pretty much with what everybody said so far. It's really looking at what you can do on-farm to ensure you're successful with the borrowing requirements. I think on-farm farmers often struggle to get across their ideas and their proposals of exactly what they're wanting to do and how they're wanting to achieve that. So I think it's important that when you are ready to meet with a bank or sit down with a bank, that you're ready to deliver and achieve that success. I think it may sound like an obvious thing, but I think the first thing farmers need to know, and those meeting with the bank, is what exactly is that investment for. They need to have itemised it and understand exactly where they're trying to go. They need to look at what the investment is needed for. Again, that sounds straightforward, but certainly when it comes to borrowing, and often if you're borrowing one sum of money, you may be refinancing other areas as well. It's making sure that everything's clear and set up. I think knowing how long the project's going to take to deliver, this has several reasons behind it. Obviously, you need to know the level of borrowing needed, but I think also from a borrowing point of view, maybe this is looking at a phased drawdown, so you're not taking all the money up front, and you'll pay interest on those on the money borrowed to where you're ready. I think You need to know the cost of the project. I think detailed costs are crucial. That's obviously come through in everything that both Robs have said. You need to know exactly how much money you're trying to borrow from the bank, what you need it for, and where you're coming from. And I think linked to that, you need to know and have in place a contingency budget. Too often we see projects trying to be taken forward that either run very short on money or run out of money. Inevitably with projects, any project undertaken on farm, you often find there's an overrun, or you end up spending money on more than one area. So it's important you build a contingency budget in there. Often that can be overlooked, certainly from a bank point of view. It can be overlooked sometimes. Certain banks will look for it and ask for it, but others don't necessarily have the same guidelines. As we've said before, I think you obviously need the business plan. That's becoming more and more important. All the banks are looking for that business plan now. They want to know where you're trying to get to, what your 3, 4, 5 year plan is. Is it affordable? Is it deliverable? I think also we're starting to see more and more grants becoming available, and I think that will be a trend going forward. The bank might want to know what your plan B is. If that grant funding doesn't come through for your project, be that robots or whatever that is, do you have a plan B? Is there a fallback option? Often for projects to be taken forward, certainly from a grant side, the grants want authority, RPA, or whoever want to see your funding is available to deliver the project. The banks will provide that letter. That's fine if the project is sustainable, but you need to make sure that that's affordable. So when it comes to meeting with the bank, this is really time to sell yourself. I think face-to-face is usually better. You can sit down, it's on your own turf, and I think it's just important that you present yourself well. I've had several meetings with clients where the client hasn't come across in the best of ways to the relationship manager. I think simple things such as clean clothes, a relatively tidy place to meet, and then making sure the farm's presentable, ensuring you've bedded up the cattle. Those sort of basic elements of your business will sell that to the relationship manager coming on farm. It is all about them buying into your business and buying into what you're trying to deliver. If you're saying a lot of it's on projection-led borrowing and saying this is where we're going to get to, if they come onto a farm and you're not bedding up the cattle, you're not doing the basics, the likelihood is they are going to be looking and thinking this project is not achievable by this client. Know what's in your business plan. That sounds really simple, but often these plans are presented by and created by consultants and everything else. We just need to make sure that you actually know what's in there. As a farmer, what actually am I asking for, and can the bank deliver that? How much do we need? Again, it's knowing knowing the figures behind what you've got in there, and knowing exactly where you're going with it. We then look at how's this investment going to improve the business. I'm increasingly seeing with banks, it's good to get them on farm face to face, and it's really good to get them to stick the boots on and take them out around the farm, take them through what you're doing now, and walk them through the project that you're looking to deliver, and get them to buy into that and understand exactly why and what you're trying to achieve for those clients for your farm. Then some of the basics. I think it's looking at what is the arrangement fee. Yes, we're borrowing this large sum of money, but we also need to know what are the arrangement fees going to be behind that. They're typically between 1 and 1.5% of the borrowing. Obviously, your risk will affect that, or the risk to the bank will affect that. But it's important that you get your head around exactly what the additional costs are going to be to this borrowing. When the banks come to review the accounts before they lend, they'll want 2, 3, 4 years of accounts to look at. A lot of farms are looking to save tax by buying new kit. When you're looking at the accounts and trying to borrow money, this is not necessarily a good thing. So I think when it comes to tax, it's important that you look at exactly what you're trying to deliver longer term to make sure that the accounts do fit the bill for delivering those new projects. When it comes to the banks themselves, I think we look at is it better the devil you know? Are you better off with somebody that you already know? If you've had a long-term relationship with a bank, I think it is important that they understand your business and your borrowing requirements. But increasingly so, we're seeing more and more clients moving over to telephone banking where they've got low levels of borrowing. So there's no direct contact with one person. That makes it increasingly difficult to get the person on the other end of the phone to understand and buy into your business, the way you're going to deliver that project and what you're trying to do going forward. So I think it's really important that people shop around. I think staying with one bank is fine, and I think if you've got a good relationship with them, there's no reason. But as previous speakers have said, there are other options out there, and it's not necessarily just staying with them just because you feel comfortable. There may well be better deals available. From this point, I'll run through a couple of examples I've got with a client. So I've got a client who is a tenant farmer. They're on a 20-year FBT. The son has taken over the business, or is in the process of taking over the business. They've got a landlord who's prepared to invest in their business. They've put up new buildings recently, but also invested over the years to make sure the farm is kept up to spec. That's all great, perfect. The farm has a low level of borrowing. They've got a bit of HP on tractors, feeder wagons, and various other bits and pieces. They've got a small-ish £60,000 overdraft, which isn't maxed out, and then they've got a loan of £27,000 from their current lender. They were looking at a new investment plan and looking at a development project where they were looking to put in a new parlour and various other bits and pieces. So initially the parlour was funded, which they put through on HP. That was fairly straightforward. And then we started looking at the wider projects. This was to put in cubicles, concrete, and facilities for housing and 140 cows for milking. It's looking at converting the old milking parlour and the feed area into a loose yard, and then also restructuring their borrowing. So we were looking to take £45,000 of season debt out of the overdraft, 40 to 45,000 out of the overdraft, and also refinance the current loan. So with a bit of refinancing structure, we were looking at a total borrowing requirement of £215,000. Now, importantly, this farm has absolutely no security to put up against this. So from a bank's point of view, it's relatively high risk, but the farm was absolutely adamant they wanted to proceed with this project. So initially we approached their current bank. As I said before, they're on telephone banking, so nobody direct to report to. We did try and get an on-farm meeting, but there was going to be a long time delay to do this, and we decided we needed to move the project forward. So we put the proposal out to the bank, looking for this £215,000. We were looking to borrow it over 10 years and see what came back. So their current bank offered them £250,000 with a bit of negotiation, came in at 6.8% over 10 years, which were meant yearly payments, capital and interest of £29,690. We felt this, obviously, at 6.8%, it was worth shopping around and seeing what else was out there. So we spoke to several other banks and eventually got in touch with Bank B, we'll call them. So Bank B have relationship managers on the ground, and we managed to arrange a meeting quite quickly with one of their relationship managers. We got them to come out to the farm. We sat down and went through the budgets. We went through the business plan, and then we spent a lot of time actually out on the farm, getting that business manager to buy into their current system, what they're achieving, and then also looking at where they were trying to go longer term and what they were trying to deliver. With a bit of to-ing and fro-ing and a bit of discussion with the bank, we then got an offer from Bank B, same amount of money, but they have put this in at 3.3% over 10 years, which obviously, as you can see from this, is a massive saving for that business over the 10-year period, allowing investment or reinvestment in other areas. So for this farm, when I first sat down with them, they were adamant they wanted to stay with their current bank. They felt as though they'd never had any issues in the past. They'd always any problems they'd had or any additional bits of borrowing they'd needed had all been sorted out and they got through. But actually, by putting this out wider, as you can see, the significant saving was to be made for this farmer. So I think it is important that farmers know exactly what they want. It's absolutely vital that they know where they're trying to take their business and what they're trying to deliver. So knowing what you need is kind of the crucial first step on this. Having a robust business plan is the next step. So Rob's talked about this. You need to know the numbers behind it, and you need to know, the bank need to know this is going to work. But from a farm point of view and an owner's point of view, you also need to know that this project is viable and financially possible in the future. I mentioned phased drawdown. We're seeing this more and more where farms don't necessarily need all the money up front. It's not necessarily something the banks do automatically. So I think when you're meeting with a bank, it's always worth asking. If you have a phased drawdown, this will be on a variable rate loan. It won't be fixed until you come to the end of the term, but it does allow you to draw down what you need as and when you want and be more flexible with the borrowing as it comes through. It's worth looking at an interest-only period. This varies hugely between the different banks. Some banks will offer 15, 20 years worth of interest-only borrowing. Other banks, you're more 1 to 2 years. And this obviously depends on your system and what you're looking for. But I think certainly with a new project and larger projects, it's definitely worth considering an interest-only period to get a new project up and running and off the ground. And as I said before, don't be afraid to shop around. There's no harm in looking what's out there. Even if you plan to stay with your own bank that you're with now, it's worth seeing what other offers are around, and actually is there a possibility to tap into some cheaper money, or even get your own bank to sharpen the pencil. And that's often the case if you shop around and look at other banks and see what's available, and then go back to your own lender and say, well, actually I can get it for this. It often can have a significant saving there. That not only goes for the loan, but it goes for the for the arrangement fees that they put in place as well. The last thing I'd say is, I think if you enjoy face-to-face banking and actually having a person there to speak to is crucial to you, it's really important that people fill in the feedback for the banks. They ask for this information every time. They yearly process the banks will go through, sending out to customers, asking them to fill in feedback. It's really important that you fill in positive feedback as well. If the banks see only negative feedback coming back on their relationship managers, which is often what happens with feedback, they will start to take them off the road. So I think it's really important that we show the positive side of this as well. And that's it, I think. Thank you for listening, and back over to you, Andrew.
Perfect. Thank you very much, Andy. That was really useful, really informative there from all of our speakers, running us through all the factors concerning access to finance. A lot to think about. We've still got a few moments left for questions. Do keep submitting those in the auditorium box if you have them. However, I just want to kick things off by coming back to Rob Hughes. A big help when accessing finance, Rob, of course, is being able to get a bit of grant funding on the side, and the growth program is just reopened for new expressions of interest. Can you just talk us through the work involved to try and get an application like that over the line? It takes quite a bit of time, doesn't it?
Yeah, these grant applications are pretty sophisticated in terms of the complexity of the information they require. Shall I just run through what that grant will do? It's been reopened as part of remobilised and unspent funds from the RDPE. So it covers off largely the same as the RDPE schemes did that we've got used to over the last few years. But we think that there's only about 35 million quid available in that grant that may extend up to 50 million. So just in terms of how that's going to work, for business development, there are three arms to this grant. There's business development, which is a grant of between £20,000, so at a 40% intervention, that's a £50,000 spend by you, to a maximum of £175,000 grant, which at a 40% intervention gives you £437,000 spend. And eligible projects are things along the lines of farm shops, conversion of redundant farm building, equine diversification, wedding venues, microbreweries, that kind of thing. There's a food processing grant with a minimum, again, of 20,000, so that's a £50,000 spend, and maximum depending on the nature of the product's process. So we quite expect that they will take some lumpy, sizable chunks of that money. And then we've got rural tourism, which has the same parameters, 20 to 175,000 eligible projects, including log cabins, glamping, conversion of redundant farm buildings. Importantly, you've got to get your expression of interest in for these schemes by the 16th of February 2020, and then you have to complete a full application. Because of the nature of the schemes, as Andrew quite rightly points out, they are complex. They'll frequently require planning permission. And of course, at every stage of these grant processes, you've got to provide 3 competitive quotes. That quoting process always takes longer than you ever think it's going to, because it's not a priority. People think, well, I'm only in with the 33% chance at best of getting this job, so it goes to the bottom of the pile. So if you've got a plan or an idea about this grant thing, explore the planning need, because that is long and painful. And you cannot put in a full application without a confirmed planning permission, and get your quotes lined up in good order. And you will also need to prove, as Andy has said, your match funding. So make sure that even if you've got the greatest of ideas, that everyone else agrees it's a great idea, and they're prepared to fund the 60% that the scheme doesn't provide you in terms of its 40% intervention. You may also think of not applying for the full intervention level in a competitive environment. They may try and spread it further by encouraging people at lower intervention levels. So there's an awful lot to think about because of the nature of these schemes, and they do take quite a lot of time. But there's lots of people out there who'll help you. They've got good track records of nailing these grants, and so just don't be frightened to speak to whoever it is in your farming community who's got experience of doing this type of thing. The other little tip I would give you is try and create a strong rapport with whoever it is, the RPA, who's dealing with grants in your region, because if they understand you and what you're doing, it's quite helpful. They tend to be extremely helpful people, but you need to work with them to capture that help sometimes. So I hope that gives you a bit of a taste, Andy, Andrew, and then we'll, any questions on that, I can pick them up.
That's really helpful, Rob. Thank you very much. We talked a lot about this evening about the importance of having good historical records, but I wanted to ask you, Rob, a little bit about that for those businesses on the line, perhaps who haven't got the luxury of that, perhaps younger farmers or someone who's just set up trading in the last couple of years, and they're thinking of trying to access finance to expand their operations. What's your advice for those folk who can't show good cash flow history going back 5 years or more?
Thank you, Andrew. The first thing is ties in with what everybody said. Is preparation and getting business proposals, business plans, even before you start. So I know you've said they've been going for 2 or 5 years, etc. You kind of need to be preparing this before. It depends where your starting point is. Are you the son of a wealthy landowner who wanted to go out on his own? Well, they might be able to put up make-weight security, so that would be very attractive to lenders. Or you might be simply, I've got a case that I've been dealing with for probably 3 to 5 years now. His family are very farming orientated and within the farming rural sector, but they're not farmers. But he's been desperate to go out there. He's been involved in young farmers from probably 16 or possibly even younger. And he's just been going slowly, just taking little chunks as and when he can afford it, always repaying any HPs he's done so that he's got a good track record on that. And he's now, I'm going to put him at 23, could be 25 now. He's now desperately trying to get into a county council holding. Now, because he's been going for that time, he's only actually shown accounts for 2 years, but we've built a good story and a good plan for him to take to Devon County Council to give a good good presentation of himself and why he would be very good to go into a small holding. Unfortunately, you can only take small steps at a time. Somebody with little experience or track record isn't going to be able to go in and set up a 200-acre dairy farm. I'm afraid it's just not viable. It's not unless they've got the bank of mum and dad or a make-weight security provider provide them behind them. It's very hard. So it is then slowly building the record with the helps of exactly the same type of people we've been talking about all the time, the professionals, and kind of not trying to run before they can walk. And I know that sounds negative, and I'm not wanting to be negative. It's just you can only do so much at a time. So I haven't got any magic wand for them, I'm afraid, Andrew. But that's slowly, but making use of the professionals that we've Rob and Andy have all spoken about.
Thanks, Rob. Just to follow up with you very quickly before we hear from Andy again, you mentioned a very interesting point there about the bank of mum and dad. I'm sure a lot of these relationships are normally quite informal, perhaps, but do you ever sort of draw up contracts or anything like that between the generations to make sure that everyone has got their backs covered, shall we say?
Obviously, I've been involved in such circumstances. I've never drawn it up. I'm not a legal representative, so I would always know the trigger and make sure. Dealing with bank of mum and dad, dealing with friends and relatives, how tentative, how scary, how fantastic when you're dealing with it until it goes wrong. And sadly I've seen both sides of this case. So I would highly recommend that you do have meetings. I speak from a point of strength, and as much as I am a farmer's son, farmers are historically poor at communicating within their own families. And I'm, again, calling on my own experiences, I've actually offered to head a board meeting for a small dairy farm, and Dad laughed at me. Son and Mum made it happen. I sat at the table and told them literally to go after dinner to put on their Sunday best, come down with agenda. 3 or 4 years later, now the son is in the farmhouse driving the business forward with a brand new dairy set up, and Mum and Dad are much happier as well. It's down to communication. You've got to understand what you're getting involved in if you're dealing with bank and Mum and Dad, and even larger, just farming families, the next generation. You've just got to keep communications open, and if that means you need to go down the legal route, I would, sincerely recommend it.
Thanks very much. Great to hear a good news story there, at least, as well as some of the horror stories that we hear.
There are some.
Andy, I've got a follow-up question for you on shopping around, but I know you have a few extra comments you want to make first on the grant scheme, so go right ahead.
Thanks, Andrew. I was just picking up on the RDP improving productivity grants that were closed last December, late November, December last year. Because they were so massively oversubscribed, it took them till about a month ago to really start returning on those that were submitted right at the end. And the problem for a lot of clients was that they'd gone through the banks and they got their approval for lending, but that was only for 3 months. So we're having to go back through with a lot of those funding arrangements to get that back in place. The RPA were adamant that they want those letters of approval again now, but often those projects are more than 3 months away before they start because the timelines have been pushed back. I think with communications with the RPA and knowing who you're talking to, you can get, they do understand if you speak to them. So don't see that as a barrier to the borrowing. If you've got it agreed once, your likelihood is you'll get it again, but don't try and get it too quickly if you're not going to start the development for more than 3 months away.
And we've got a follow-up question from a Charlie Palmer who's been listening on the line. He just wanted to double-check. Andy, can you help Matt here? Do you need planning permission in advance of these applications, or can you get it subsequently for RDPE?
In general, you need the planning permission in place for this project because they won't lend against a project that's not confirmed. In general.
Fab. Thanks very much for that. I just wanted to follow up with you on good to hear you're a big advocate of shopping around. I certainly do that with my personal finances, but I know it's more challenging for businesses. With regard to online-only banks, there's a few of them around now. Are they really a good setup, do you think, for the average farm, or should farmers still be looking mainly to the high street then? Just talk us through the differences.
That's a good question. I think in general, most farms tend to go to the main high street banks to start with. I think, as Rob said before, you've got different different tiers of lending, and it really depends what you're looking for. Farmers in general like that face-to-face contact, so I would say all of my clients, I don't think I've got any clients that are using an online bank specifically for their farm borrowing, if I'm honest. They tend to, absolutely, they're using the peer-to-peer lending and other bits and pieces in there, but in general, the majority of clients I've got would be using high street banks, so they've got that contact. I think it depends what you're looking for, what your borrowing requirements are as to really where you go. But yeah, I don't know whether anybody else has got, any of the other speakers have got any thoughts.
So it's Rob Hughes here. I think you're right, Andy. It depends on the requirements. You can't answer that question broadly. It depends on what the needs of the individual business is, so that will dictate what service they can get from the provider.
Thanks very much, both. We've got time just for one final question. Rob Hughes, I just wanted to pick up with you. You were, of course, espousing the virtue of good forecasting as part of any application for a loan. And I know there'll be some farmers out there now who will say, that is with the weather. Not many people would have foreseen, for example, the wettest autumn on record we're approaching now. How kindly do banks look upon these changing circumstances when people are facing, very significant changes in their income on a year-to-year basis?
I think generally there's a significant amount of sympathy when the performance of the business is hugely impacted by factors that the business proprietors have no control over. So where we've got this filthy weather that's affecting East Midlands and Lincolnshire and up through this, the central band in the country particularly, but there's an awful lot of potatoes not being lifted in East Anglia. There's a high degree of sympathy and support from the banking sector, but you've still got to be able to repay the money. So you've got to create this picture and in a reliable format, and that's where variances and sensitivity analysis on your budget are terribly important in terms of the overall stresses and strains and risks within the matrix. So, and coming back to your grant question, we've certainly got clients who have applied, and then now we've just learned recently have been successful in the grant application, and they're saying thanks very much, but given the circumstances of my likely cash flow over the course of the next 12 or 24 months, I'm not going to take the grant up. People are walking away from these grants for perfectly solid, good reasons, because their business model has taken a huge wobble, and they're reassessing the whole risk matrix. So, yeah, it's about controlling and understanding, isn't it? And as long as you've got that understanding, you can have the control, and then you know where it goes when it goes wrong, in the same way as where it goes when it goes right. But we're in for a difficult time, and prices have moved up a little bit, but not a lot. And the numbers we're looking at clients now are realistic clients for cash flow spring 2021, accepting entirely it's a very long way away. Those numbers don't look very inspiring just at the moment in terms of our plan, what we're going to then do about capital expenditure and how we're going to meet the cash needs of the business following what we suspect is going to be a difficult revenue year, Harvest 20. So it's about realism, isn't it? And contingency.
Perfect. Well,
That looks like it's about all we have time for. So on behalf of all the speakers, Rob Hughes, Annie Dodd and myself, thank you very much for listening. And of course, our thanks go out to each of those contributors. And you will be getting a copy of the slides by email once this presentation is over, and there will be an opportunity to follow up with any of the speakers afterwards. Thank you very much for attending, and good night.